All right, we are getting going. Oh man, just these days get away and you're like, what happened to 4:30? My friend Roy Chipkin calls me Mr. 4:30. I hope he continues to call me that because I just like, what can I tell you? Gotta fix my boom arm. I've been using this a lot. I do the radio show. I do a couple of Zooms a day, and it's just I'm so glad I have all this video equipment because I use the hell out of it. Yeah, I use it a lot. So, yeah, let's just get the show started by the title. Do you know that the Dow is only about 7% away from hitting an all-time high? If you just stop a second and get out of the Silicon Valley Bank thing, look at the inflation numbers. Today, the producer price index came down. That's considered a harbinger of what's to come in terms of inflation. And it was not just in line with expectations, it went down. I'm talking down inflation, not just like flat or a slower rate of growth. It went down. And it's getting people excited. Now, this market has I feel like the stock market has this terrible personality disorder where it's going from, you know, thinking everything's going to be back to really good, or everything is going to go bad really fast. And even though the Great Recession and the market of 2008, 2009 is a long time ago, we still talk about this like it happened yesterday. And that just goes to show you how painful those times were. People's retirements were wrecked. And even though the market has more than recovered, way more, it's people are still jaded by it. It was there's an awful lot of people in this country that went bankrupt. There's an awful lot of people in this country from that time that who lost their home. There were people who were making really bad decisions, and I'm not talking just like consumers. The investment banks, for example, the amount of credit that was going around, the amount of risk that large financial services firms were taking, so big that if they fail, they could bring the whole system down with them, and they were taking these crazy risks. Just a quick note about those days. I don't just sit here and blame the large financial firms for what happened in 2008. I think a lot of consumers have to take some responsibility too. No one asked people to apply for mortgages that they couldn't afford and leverage up and buy a lot of real estate, a lot of houses. People had their choices to make. There was free crack, and people have their choice if they want to take it or not. Maybe it's just people can't resist the crack of cheap money and low lending standards to buy whatever they want, as much as they want, and be totally hedonistic. Personality, what is it? Personal reliance went out the window. It was a really rough market. Storied names like Freddie Mac, Fannie Mae, AIG, Lehman Brothers, Bear Stearns, Washington Mutual, and others, they just disappeared. And Fannie Mae and Freddie Mac, those were semi-government entities, and they still disappeared. And people thought they were always guaranteed. Well, they've got the guarantee. No, there was an applied guarantee. But nope, they couldn't be saved either. AIG in its current form is just a shell of what it used to be. Even Citigroup is a shell of what it used to be. I mean, you see the stock up, but they did a 10-for-1 reverse split. So the stock hasn't really gone anywhere in like 13 years. Just ask anybody who works at Citigroup, how they're doing with it. It's just the stock never seems to go up, right? It's just a giant reverse split. GM went bust, was taken over by the government, and was reissued as a new stock. it was just a very painful period. So people keep talking about that like the last time we had a bank problem, and you run right into like the worst possible worry. Well, what I'm telling you is, if something really bad happens, you haven't even thought of it because it's a black swan event. The stuff that we can envision, that we can think of, that we can prepare, is the stuff that doesn't kill the market. And not every bear market and debacle is the worst thing ever. We get through these things. Can the Federal Reserve and the Treasury Department keep rescuing the United States economy and the global economy every 7 to 10 years? Probably yes. Do we want that to happen? No. The banking sector today is nothing like what it was back in 2008. But we keep going back to that, and it's just a worry that people my age can't shake. Now, I know a lot of you are younger than I am. I'm 55. So a lot of you could be, 20s, 30s, and you tried your hand at trading. You got your stimmy money. You went on Robinhood during the pandemic. It was easy. People were making money. There were all kinds of Zoom meetings to talk about stocks, and everybody was a genius. I bought this, I sold it at that. You were just trading. You were riding momentum. You were looking what could go up. Everything was going up, though. And somehow people magically thought that they got a little smarter. And, you guys had your comeuppance, too. So we all got smashed. We all have something to fear. And we all went through a lot of pain. Every generation has to learn its lessons. So what's going on with the market now is that I think there's a lot more fear than is warranted. And this is why we say you just have to keep cool, stay invested, keep diversified, which is a strategy that, diversification is a strategy that we use to reduce risk because we're not putting all our eggs into one basket, but it doesn't necessarily protect your portfolio from going down in a generally down market. Last year was a great example of that, by the way, when bond funds were down 10 to 20% across the board, and stock funds were down 10 and 20% and even more across the board. So nothing helped you last year. Like usually when stocks get crushed, bonds go up, you have something working for you, but everything just got crushed last year. This year is a much better year. It's believe it or not, with all of the volatility and all the bad news out there, it hasn't really been that volatile of a market. A lot of people don't realize that. All right, so I just want to put things in perspective. Let's roll the quick intro. Then we're going to talk about the Dow Jones. I'm going to teach you a little bit about what that index means and why it could move up and how it works. Here we go. And we're back. We're just kind of getting started. I take a long time to get into my intro. My introduction and my live stream sometimes comes so late after I get started that I might as well call it an outro instead of an intro. Ha! Ba-da-bum. I don't know. Here we go. Can you hear that? Yeah. All right. I need to use my sound effects more often. So, I need to use my sound effects more often.
That's what she said.
I just felt like doing that. So, where the Dow Jones is about 7% away from hitting its all-time high. 7%, I'm not saying it's nothing, but if you think about it, a couple of good weeks, a couple of good days here and there, and we're at record highs in one of the major averages. Nothing like getting bulled up in the market with an average making a new high. And with all the talk about that we haven't put in the low yet for this current bear market cycle, that we have to retest the lows in this current bear market cycle, that we just can't possibly keep going up in this bear market cycle. For all the talk, why? Why can't we hit new highs? Why do we have to retest the previous low of last October? Why do we have to do this? People are talking in absolute terms. We have to do this. We have to do that. The market doesn't have to do anything. Certainly doesn't have to do what someone else thinks it does. The market does what the market does. We really don't have control over that. We like to use our, past information, knowledge, experience. I have that. Charts, graphs. It helps us feel like we have control in a situation that we don't have control. Maybe we go into a recession. I mean, everyone's talking about it that we're going into a recession the second half of this year. maybe we just have a soft landing where the economy slows down enough to bring down inflation, but not enough to cause a recession. Maybe we go into a mild recession. The talk now, generally accepted wisdom is that we go into a mild recession second half of this year. Maybe it becomes a deep recession. We just don't know. And what I tell my clients is I have my own views of what's going to happen, but I'm still not, judging or I still don't want you to base your retirement on just my opinion. Don't get me wrong. I value my opinion as much as the next person. Hey, I'm just a guy. And us guys love the sound of our own voice. La da da, my voice. But seriously, I don't want you to. My view of if the market goes up or down in the next 6 months should not be what you base your future on, right? I mean, how stupid is that? What I want to do is I want to invest based on your risk tolerance, your time horizon, your age. I want to create a plan. When should you take Social Security? I say this every day, right? It's boring, but it's true. Well, do you have enough life insurance for the what ifs in life? How's your spending? Based on current trajectories, let's do an analysis and see if you're on track to retire, or maybe you need to work a few more years or a lot more years. You have questions that need to be answered, because if you have these questions answered, you'll be more likely to take an actionable step. Just investing for the long term, just saving for a rainy day, that's not good enough. It sounds good when you're a little kid and your grandparent says it to you, but it's not going to motivate you to sacrifice as an adult when you just want some happiness. But when you do the trajectories and the planning and you see what's really possible and how close you could be or how far you could be away from something, that is what gets you to move, to stick with a plan, to invest every month in your 401k plan, that sort of thing. That's what I want to get you to. Not just give you, save money for a rainy day. First of all, I hate that expression. An emergency fund is for a rainy day. Savings is for expenses that you have coming up. Emergency fund is for expenses that you don't know what's coming up. An emergency fund, a rainy day fund. And the rest gets invested or pays down your mortgage or pays off your car, gets rid of your debt, buys a second home, invests in real estate, something. Yeah. Now we're getting somewhere. But don't you want to know if you're on track for this stuff? Then you'll be motivated to actually work toward the goals. It's hard to think about sacrificing money to put in the market for 30 years to leave it there for another 30 years after you retire. And you don't even know if the money's going to go up, go down. You don't want to be like, I should have just spent all that money and had fun with it because the market's down so much. I just lost so much money. You should never have your retirement or your financial goals on the line because of a bear market. It means you're doing it wrong. It's not that the market did wrong. You did wrong, or your financial advisor, because you know that as you get closer to your goals, you start moving that money into cash equivalents or other stable type investments as you get closer to the goal. This way, a bear market doesn't throw you off your game. In fact, for most of us, a bear market's our friend. It gives us an opportunity to buy shares in the market cheaper. More shares for the same amount of money. So when the shares go back up in price, our net worth really blows up, really just expands. That's what it's about. Okay. Thank you so much, Stacy and Jerry. I really appreciate you two being out there. You guys are just like my favorites. Thank you so much. If you have any questions, folks, hit me up in the comments. I love to hear from you. It's the best part about what I do. check me out on YouTube or any of these other fine social media platforms that you can see on my screen. I post daily on, in social media. I love doing this stuff. And all right, let's take a look at the Dow Jones real quick while I have you, because this is going to be very simple. The Dow Jones, it's 30 stocks. It's considered a narrow index, only 30 companies. It's called the Dow Jones Industrial Average. The Dow Jones Industrial Average moniker makes no sense, because the Dow Jones Industrial Average, it's not really an industrial average. There are a few stocks in it that are industrials. So let me share my screen with you. Put myself up in the corner. Okay. Let me share with you who's industrial. Okay. Caterpillar's industrial, right? Caterpillar. Boeing's industrial. Honeywell's industrial, right? Honeywell. That's 3. 3M, you could say, is industrial. That's 4. Dow Jones is chemical. I'll give you to industrials. That's 5. There's 5 industrial type, smokestack type companies in the Dow Jones. So it's not really an industrial average. It's just 30 companies that are representative of the American economy. They should just call it the All-American Index or something, the 30 big American stocks. They're not even all the biggest stocks, by the way. So that's one thing you should know about the stock. It's not about the index, rather. It's not an industrial average. If you want to see a better example of an industrial average, you could follow XLI. XLI. Let me put that up on the screen. XLI. That is Industrial Select. That's a Spider's Select for industrial stocks. Okay. This is a much better way to view industrials. Just to give you the quick update, year to date, that's at 1.77%, while the Dow, I'm getting there, okay? Just give me 1 second. The Dow, it's up a lot more. It's up 2.66%. See that 2.66? So why is there a spread? All right, I get it. 1% change in 2.6%. It's not the hugest difference in the world, but why is the Dow up more than the industrials, the XLI, the industrial stock exchange traded fund I just showed you? And why am I saying that? That's a better representation of technology stocks. Well, the XLI. Let's just take a look at what's in XLI. Okay. I wish I had these screens put up here, but honestly, I wasn't sure exactly that I was going to talk about all this stuff before I started the show. Okay, but let's take a look what's in XLI. Top 10 holdings: Raytheon, United Parcel, UPS, Honeywell, Union Pacific, that's railroads, Caterpillar, Deere, Boeing, Lockheed Martin, General Electric, and Eaton. It's industrial stocks. Believe me when I tell you, the only stocks in it are industrials. Whereas the Dow, how much technology stocks are in it? Microsoft, 1. Visa, I think you could count as a technology stock. That's 2. Salesforce is 3. Apple is 4. Cisco is 5. Intel is 6. So there's 6 technology stocks of the 30. That's 20% of it, right? Those aren't really those aren't industrial stocks. What about financial? I don't know if you consider United Health financial. I don't. Goldman Sachs is financial. It's 1. Travelers is insurance, 2. American Express is 3. JP Morgan is 4. So 4 of the companies are financials. What are financials doing in industrial average? I think you're getting my drift, right? And let's take a look at healthcare. Last one, right? United Health, Amgen, Johnson & Johnson, Merck, Walgreens. I don't know if you call Walgreens a healthcare stock. I mean, certainly it's in the healthcare business, though. You get the drift here, right? It's not an industrial average. It's just companies that are in it, and I really don't see a rhyme or reason of what the you know. I don't see a rhyme or reason of what the process is in terms of maintaining this index, except that stock goes out, stock goes in, and sometimes it's a tech stock that goes in, sometimes it's a drug stock that goes in, sometimes it's an industrial stock that goes in, sometimes it's financial, whatever. Okay, it's just like a hodgepodge of stuff. Okay, now what's the most important stock in the index versus the biggest mover, the biggest impact? It's United Health. There was actually an article about that in CBC today, but we've spoken about this United Health well before that article. We've spoken about this a bunch of times, okay? But United Health, why is this the most impactful stock in the Dow Jones? Because of the price. See, in the S&P 500, you can't invest directly into an index, but you can invest in a security that tracks. Remember, it's an index. I just have to keep saying that. Apple and Microsoft are the biggest two stocks by market cap. Okay, so they're the biggest stocks in the S&P 500. They have the biggest impact in the S&P 500. They're big enough to move the market. But no, it goes by price here. So the biggest price is 526 now, which is United Healthcare. So United Healthcare at 526 is a bigger deal than Microsoft at 289, and a bigger deal than Apple at 165, because the price of the stock is what counts, not the size of the company when we're talking about the Dow Jones Industrial Average, which ain't so industrial. And then you take a look at what's really barely moves the needle. The bottom three: Verizon, Walgreens, and Intel. They're small. They have a very small impact on the overall average. If Intel was to go down $10 a share, all else being equal, the Dow would be down a drop. But if United Healthcare went down, percentage-wise the same, that would be a huge impact because it's price-weighted, not market-weighted. So there are 30 stocks in the Dow Jones, few of which are actually industrial, everything of which is something else. So I don't think it's a great way to value anything. I don't think it's a great way to look and see how the market did today when it's up. But having said that, it still is very widely followed. It's always quoted whenever you hear about the market. You hear about the Dow Jones, the S&P 500, and the NASDAQ. You don't hear about the Russell 2000 and other averages that I think are important to investors. However, you can't invest directly into an index, but you can invest in a security that tracks an index. Oh my God, I keep saying that. But XLI is a better way to view industrials that we just went over. So that's my story. That's why I'm sticking to it. And but if it does go up to a new record, 7% isn't that far to go. I think it'll add some goodwill to the street. I think it takes out the argument that the market has to retest its lows, because the market doesn't always retest its lows. And by the time everybody expects something and is talking about the same statistic, it's usually obsolete by then, and we have to find a new statistic to hang our hat on. That's the story. I thank you for watching. The market was up today because it appears that inflation is coming off. One strategist thinks inflation could be 2% by next year, early next year. If that were to happen, the market, in my opinion, will be much, much higher than where it is now. And since inflation is trending downward, don't we have to pay attention to that, not just be overly negative? Or how about we just invest based on you, and you'll capture the returns when they're there. You'll compound, reinvest, and stay invested when they're not there. And over time, I think you'll be fine. How about that? If that's what the whole show is about, you wouldn't watch, though. But that's what we need to focus on. I just want to give you all the other education and everything else you need to know so that you have a better ability to stick with a financial investment plan that's more to your liking based on you. Because I always ask, what good is a plan if you can't stick with it? I help you create plans that you can stick with. Mitch Goldberg, signing off. Be back Monday. I'll be in tomorrow for the radio show. Have a great day.